no delivery forecast. But let's start off with something that Ross Gerber was telling us here on the program earlier in the session here, that he was really looking closely at those gross margin numbers, 17.6%. And when you adjust here for those regulatory credits, 17.2%.
Yeah, and it's important because automotive gross margin, X those credits, slightly above what were muted expectations. Tesla still has industry-leading margins for making electric vehicles. You know, if you strip out ZEV and you strip out the benefit of software, they still kind of lead in this space. But in the final 3 months of 2023, discounting price cuts, using that lever in both directions was a factor, along with, despite it being a record quarter in terms of sales, you know, an impact on the bottom line, which they've kind of stayed the course on.
I think it's interesting, too, when we talk about the gross margins holding up. Also, the free cash flow number came in well above estimates, more than $2 billion. I think the street was only looking for 1.5 here. Is that kind of a one-off here, or is there a trend line that we should be paying attention to?
Well, they're being efficient at a time where they're trying to ramp up production of Cybertruck, which is a new model. You have to spend to bring new product online because of the time it takes to staff up and tool up new assembly lines and the investments that are needed for that, at the same time as their profits taking a hit from the macro environment that we're in. But also, you know, this is the kind of first real financial read we've had since Zach Kirkhorn left as CFO. And Zach was a very good manager of the bottom line and very good manager of Tesla's cash position. His departure doesn't seem to have impacted that trend.
I want to go to something that Tesla said, which makes it really difficult to understand what's going on, which is that volume growth will slow notably. That's pretty vague, and we know that for 2023, they delivered a record 1.8 million vehicles, and a lot of analysts were anticipating something in the neighborhood of 2.2 million vehicles for this year. What does it mean when Tesla has talked so much about a 50% annual growth rate in deliveries?
What's critically important to state is that 50% CAGR, which goes back to early 2021, starting from the end of the 2020 financial year, related to production. So what they're saying on a compound average annual growth basis is that they would increase their production capacity and the number of vehicles they built by 50%. They built more than 1.8 million in 2023. Had they maintained that 50% CAGR, they would have been on track to build 2.5 million in 2024. But they're saying the opposite. A, they're not giving us formal guidance. They've omitted that from the volume, the graph in the deck titled volume. But what they're saying is that while they're ramping up their first-gen models, Y and 3, they also have imminent plans to bring on this next-gen model that we have few details about, which will be built in Texas. And for that reason, they're guiding us to substantially lower growth. But that growth, again, it is on a compound basis, and it's based on production, not delivery. But you can extrapolate out, right? And if they build less cars, they have fewer to deliver to customers.
And when we talk about this next-gen platform, we're talking about the lower-cost sedan. Is that right? Why not just go with that? Next-gen vehicle makes it sound like it's going to be ramped up to something akin to the Cybertruck.
Well, I don't know if you guys have your Tesla bingo cards printed on your anchor desks right now, but this will be a or the question for the call. You would have seen the Reuters report that Tesla has informed suppliers to brace for this. The understanding and the hypothesis for a long time has been that this will be a much lower price point vehicle, $25,000. The bill of materials, therefore, will be completely different. The lining up of the assembly lines in the factory in Texas, which is already trying to handle Cybertruck and Y, that needs to be thought through as well. So you think of it almost, in many cases, as downtime, preparing that facility for a product that is not yet there, but will impact the production of those that are already in production.